Hey everyone, today I'm going to talk about a way to invest in real estate without having a large amount of capital. The instrument that lets you do this is called a REIT or a real estate investment trust. So let's get started. In most countries, a company which fulfills the following set of criteria can be classified as a REIT. First, 75% of their assets need to be in real estate. Second, 75% of their income needs to be from real estate rental income or interest on mortgages. Third, it needs to distribute 90 to 100% of its taxable income to its shareholders via dividends. There can be additional restrictions such as number of shareholders, types of shareholders, etc. But in general, a company that fulfills these criteria can be classified as a REIT. So in short, a company that has its primary business in the real estate industry and draws its primary income from the real estate industry is known as a REIT. Holding shares of a REIT allows you to be invested in the real estate industry without having a large amount of capital. Let's take a look at a few ways to classify REITs. REITs can be classified into three categories: equity REITs, mortgage REITs, and hybrid REITs. Equity REITs. These companies acquire, build, manage, or sell income-producing real estate properties. Mortgage REITs. These are companies which lend money to organizations that operate in the real estate industry, and they make money via the interest that they charge on these loans that they give out to such companies. Hybrid REITs. As the name suggests, these companies are a hybrid between equity REITs and mortgage REITs, and they make money doing both activities. There are many industries in which a REIT can operate or specialize in. Certain kinds of industries do better at certain points in time. So for anyone involved in active investing needs to evaluate the performance of each sector during different points in time to find out the REIT which is best for them. Another way to look at REITs is public versus private REITs. So public REITs, as the name suggests, are REITs which trade in financial markets. Their shares are available to you, the retail population, and their market price is also known to you at all times. These are traded on a daily basis, whereas for private REITs, they do not trade on financial markets and their price is not known on a day-to-day basis. What are the benefits of REITs? Diversification. Diversification because it allows you exposure to real estate industry or real assets without having a large amount of capital. Second, inflation hedging. Inflation gets factored into real estate prices over a period of time, thus allowing you to have an asset in your portfolio which is inflation adjusted. Next is stable income. Since REITs are required by law to distribute 90 to 100% of its taxable income to you, the shareholder, it gives you a steady stream of income through dividends. Next is liquidity. Just like shares, you can sell your REITs at any point in time when financial markets are open. This gives you an enormous amount of liquidity, which is simply not available if you're directly investing into the real estate industry because it takes some time to liquidate the asset for you to get your money back. Now let's look at some of the risks of a REIT. First is taxation. REIT dividends are taxed as an ordinary income, which subjects them to a very high tax rate. If you're comparing the rate of return on a REIT, then you need to factor in these taxes as well when you're comparing the returns of a REIT to returns of any other financial instrument. Second is leverage risk. REITs pay out 90 to 100% of its taxable income to the shareholders, which means they don't really have any money to expand. So, if a REIT wants to expand, they will need to raise more money. If they raise more funds through debt and the underlying assets stop performing due to an economic downturn, then a REIT's bottom line would get impacted the most because of its increased cost of borrowing and a reduced performance of the underlying assets. Now, if you're interested in active investing, then a detailed analysis of the sector in which a REIT operates, as well as the underlying assets, becomes quite crucial. Next is market risk. A high interest rate negatively impacts the real estate industry because it increases the cost of borrowing, thus making things expensive everywhere. Now, whether you are an active investor or a passive investor, I'm going to show you a few websites where you can shortlist REITs, research on them, and screen them if required. You can use a scanner like alreits.com. Here, you can filter REITs by country, sector, and a few other parameters. I have filtered REITs by Canada for now, and I'm sorting them by their 5-year adjusted return. You can look at a REIT's 5-year, 1-year, or year-to-date return along with its dividend yield. It is important to consider both dividend yield and the market return a REIT has provided over a long period of time. You can also click on any REIT you like and look at its fundamentals in more detail. Actively selecting a REIT would require a bit of due diligence. If you do not want to go through it, then check out passive investing. In my earlier video, I talked about passive investing, and how ETFs are a great way to invest passively. And as passive investors, since you do not want to spend the time to research and identify the outperformers, diversification becomes quite crucial to your investments. REIT ETFs are ETFs which invest in various REITs, so they diversify for you. This diversification becomes quite important because some sectors might outperform while others are underperforming. And as passive investors, since you do not want to spend the time to research and identify the outperformers, diversification becomes quite crucial to your investments. Now, let's look at some ETF screeners, specifically REIT ETF screeners, which can help you find the right ETF. ETFDB. If we look at the screener, then it allows the ETFs to be filtered by asset classes. The results can be sorted based on performance, and additional information on each ETF, such as dividend yield, fundamentals, and performance, can be researched. Morningstar is another great screener which can help you find a REIT ETF based on performance. You can search for REIT ETFs and again explore individual parameters of each ETF if you so choose. All the websites I've shown are mentioned in the description below, so feel free to check them out.